and we expect maybe a particular dividend at the end of the year or at then automatically that changes the structure of the business. You may be asking me, why am I talking about a limited company when we are doing a partnership? It's very important that you look at a question and you differentiate what is a partnership and what is a limited company. So we'll look deeper into a limited company now next class, because that's what we'll be looking at next, company accounts. But for now, it's just important that you know that with a partnership business, there are different things that make it a partnership difference. You add a partnership business, you will refer to the items that we looked at the beginning. Those were the things to do with requirements of a partnership. If I may just go back up here. Contents of a partnership agreement. So when there is no partnership deed and maybe you're still seeing 10 of us in the same business, then there could probably be a memorandum of association, which is a document that is going to stipulate how the business is run, or how a company is run, or how a limited company is run. So let me get back to my page so that you can continue. So we have been preparing, like I told you last time, we have been preparing our accounts on basis of going concern. We prepare our accounts assuming that in the next period also, the business is still going to continue. So even anyone who looks at our business will look at it and know that this business is not closing anytime. But when it comes to dissolution, the partnership is changing. It's probably not going to be existing anymore. We are killing off the partnership. Even if we are going to make it even if we are going to turn it into a limited company, that partnership will never exist. So we have to close the business or the partnership business. So whether we are selling off the business, whether we are converting it into a limited company, as long as we are closing off a partnership business, then we have to record these items, not on basis of going concern. That means that we have to close off our accounts. That's one of the major differences that you're going to see with dissolution. So in case there is a dissolution, in case the partnership comes to an end, in the following order is how you're going to close that partnership. You will pay, or there is going to be payment of non-partner creditors. Those are debtors and other liabilities. That is to say, everyone who is demanding the business, apart from the owners of the business, that is the partners, every other person who is demanding a business has to be paid first. Panange, don't pay yourselves if you're the partners. No, and then you go and tell your creditors that you don't have money when you've already paid yourselves. It's not ethical. Even you as the accountant for a partnership, don't allow the partners to take the money first before they settle their liabilities. And of course, but why I'm saying it like this, that so that you can remember that even in exams, you have to write that you have to show that you're going to pay your non-partner creditors first. After you've paid your non-partner creditors, because that's the most urgent. That's the most urgent item. The next item on the agenda will be payment of partners' loans to the partnership. So in the event that a partner gave like a loan to the business, last time we saw one of the partners gave a loan to the business. If that business closed, the business has to pay the partner's loan. Before they even give him back his capital, they have to pay his loan. The next thing that they have to do is payment of the partner's entitlements as per their balances on their capital and current accounts. This is basically saying you then pay the partners last. So after paying the non-partners, after paying any partners' loans, then you go ahead and pay now the partners. That is, you give them back their money, ideally. That's what it's saying. So we have the different double entries on how this is going to happen. First and foremost, we are closing off the business. Before we even look at the accounts, let's take it like it's a normal business. We said we are in FA class, and we are a business. Okay, we are a business. We decided to come up with our business. We are maybe importing cars as an hour class, the way we are here. Then we decide that we are going to close off our business. How are we going to close off that business? Of course, we're going to liquidate it. That's what we're basically meaning. So we need to sell everything that we have so that we can all share the money and part ways. So we may decide to sell all our stock. Since we are importing cars, we may sell off our stock maybe to like another bond, or we give them out at discounts just so that we just basically break even. Then any other assets, if there are any computers that maybe was having, we will sell them off first. Why are we selling off the assets first? Because we have to pay off any liabilities that we may have. So if we've been maybe getting these cars, we've been wholesaling them, like we've been buying them from our supplier at a wholesale price, we'll try to probably sell off that stock at a wholesale price so that we can pay our supplier. If we have maybe land, a company land, we have company buildings, we will liquidate all the assets first so that these assets may be able to cater for the liabilities. Remember, we have been talking about this ever since. Remember, a healthy balance sheet or a healthy statement of financial position is one where our assets are equal to our liabilities. So if we have assets worth 100 million, we should ideally have our liabilities worth 100 million. Okay, so we need to be able to get, and usually remember we have our assets, usually they're in terms of land, land receivables, maybe stock, then we have maybe just a bit of equipment. This is a small company. So you find that this total 100 million is broken down into that. And then you'll find that on our liabilities side, okay, we'll have probably capital. Let me put our capital there. It's maybe worth 50 million. We have liability. Sorry, let me just assume we have retained earnings. Retained earnings worth 20 million. Maybe we have an overdraft worth 10 million. And then we have our payables worth, if that's 50, 20, 10. So we have our payables worth 30 million. So ideally, the first thing, this is how probably our statement of financial position has been looking. So as per our last balances, this is what we had. Let me just try to value the land. Maybe the land cost us 30 million. Our receivables are worth 20 million. Our stock is worth 40 million. Our equipment is worth 10 million. So what is going to happen is that when we decide to close off our business as FA class, like I told you, we need to be able to pay off these debts first. These retained earnings and the capital are usually in one account. So we'll look at them later. But this overdraft, we need to pay the bank their money and we need to pay our suppliers their money. We are not going to run away just because we never want to. We are probably assuming that we will not do business with them anymore. So what shall we do? For us to come up with the cash to pay, okay? For us to come up with the cash to pay this 30 million and the 10 million, we could probably sell our land so that we pay off the payables. And then we could demand these receivables. If we don't, we are assuming we are lucky, we don't even have any bad debts. So we could probably ask these people to pay our money. We tell them we're going out of business, please send our money. They give it to us. Then we pay off that 10 million. So we would have used up our 50. So we would liquidate our stock. Okay. we liquidate our stock, and maybe we are lucky we get exactly 10 million from that stock. And then we also have equipment worth 10 million. So that means that at the end of the day, we are going to sell even our business, and we're going to stay with extra cash. We're going to pay off our liabilities, and then the remaining money is going to be paid back to the owners of the business. That is in form of the capital. So the 50 million will be able to cross out that 50 million here as capital. I hope my math was right. This is 70 million, this is 50. Okay, so, and of course we already have our other extra profits here. So that is what is going to happen. We're not going to start now going forward, then we start doing another balance, another statement of financial position. Now we are showing current assets and non-current assets. That's not going to happen. When we are closing off, there's no reason for us to start showing for that we have balances. The word balance is a word that is used in a situation where there is going concern. So once you see balance carried forward, balance brought forward, you know that the business is continuing. Once you don't see those words, please don't invest your money. Don't also apply for a job that in a company that doesn't have those words there. You end up doing the strange activities when the job description was saying something else. So the accounting entries. So usually when we are selling off those assets, like I've shown you, we're not just going to call people for cash. What we shall do is that we shall close off all the asset accounts. So like you've seen these assets here. We're not going to just go to the bank and say, give us land, give us 30 million, what, no. We are going to close out the asset accounts first. How do we close them out? Remember, if our NCA, that is a non-current asset account, before had maybe usually on the debit side, it has a balance of the bank, which is 30, balance of the land, and so balance carried forward on the other side. If we are closing off, ideally, it would be the 30 million. So that in the next period, we open up that extra 30 million. But now, if we are closing off in the year, and we have our balance carried forward being, our balance brought forward being 30 million, we're not going to have another balance carried forward being 30 million. Instead, what we are going to have is we are going to take this money to an account called a realization account. So it's like a holding account. It keeps assets until we liquidate them. Like we're going to see just in a while how it looks like in terms of a T account. We have, please be careful, we have a revaluation account. That is what we looked at last week, revaluation. Today we have talked about realization. Be very, very keen. Don't just jump on the question just because you've seen a word that looks familiar. No. We have revaluation, we have realization. Revaluation happens when when there's a change in partnership. We revalue our assets. We get a new value for the assets. When we realize, in accounts or in finance, we have a term called realization. I do not have a proper English word for it, but it's basically to say, it's like to match it in layman's English or in normal English. It basically just means materializing, making existence of something. So when we realize, it's like we are getting something. That's what it basically means. So be very, very careful. The realization account is going to help us liquidate our assets. It's going to help us realize the value of our assets. So be keen. Revaluation, change of partnerships. Realization, closure of partnerships. Okay. So I believe we can now move on. So when the first entry that we will do is that we're going to transfer all assets except cash and bank, because we can't realize cash. It's already cash. Everything else is we want to realize it into cash. So all assets except cash and bank balances will be taken to the realization account. How will they be taken to the realization account? We shall debit that account and we shall reduce the assets account. Remember, I've told you countless times before, we should keep our double entry in the tips of our, we should keep our double entry in our fingertips. So moving on, we debit the realization account with the book values. Book values, not the cost. If you bought your car at 20 million, don't come and write in the realization account 20 million when your car is now worth 5 million. You're not going to lie to anyone that you're going to realize that car at 20 million when you know it has depreciated all the way down to 5 million. So we need to record at the book value of the assets. Remember, up to now, like I keep on saying, when I say book value, I mean the net book value. When I talk about the net book value, I mean the cost minus the accumulated depreciation. So we have now transferred our assets into the realization account. We are now going to sell them. We sell them, of course, for cash. Or people may write for us checks. So we shall debit our bank or cash and we shall credit our realization account. So we are receiving money in the bank and we are reducing our realization account with the sales proceeds received with the exact money they've given you. So if we were selling our car that had a net book value of 5 million and we sold it for maybe 4, then we have realized our car at 4 and we have made a realization loss of 1 million. Maybe we sold that car at 6 million and someone was even kind enough to help us buy that car at 6 million. So we made a gain because we had a net book value of 5 million, but we were able to realize 6 million from the value of the car. After that, then the part in case, sometimes we may not necessarily sell to people. We may be in our company here. We said our company is doing what? It's selling, we said it was selling cars. Because we have been selling cars when we are moving on borders, we decide to say, you know what? Let's just take over our assets. Let's take over our stock. So each one of us gets the stock from the company and we own our cars and we own those cars. We say, you know what? You give me that car, I'm going to be there to pay for it. So of course the business is going to demand you that money. How is it going to demand you that money? Your capital is going to increase. And we know that capital is a liability, is on the liability side. Okay, so you will, in case the partner takes over the asset, the partners, we shall debit the partner's capital, okay? Because you're paying for it using ideally you're paying for it using your capital. So your capital is going to reduce. That's why we're going to debit your capital account by the value of the car. So if you've taken a car worth 100 million, then we are going to, your capital is going to reduce by that 100 million. And we shall, the corresponding entries that we shall credit the realization account with the agreed takeover value. When the liability is paid, that is, we are paying now our suppliers and whatnot. Of course, we know that liability is reduced by debiting them. And our bank balance is also going to reduce. Hence, we shall credit it. We shall credit the bank balance and debit the liability account with the actual amount paid. Just because you had liabilities worth 400 million and you've only managed to pay 20 million, don't lie to people that you were able to pay the 400 million. Show only what you have paid. If a partner takes over the liability, like we saw last time, those guys were taking over a loan. Someone took over 40%, another person took over 60%. Of course, like I told you, when someone comes to the statement of financial position, they may never know that there was indeed a loan, but instead they'll see that one partner's capital value increased. So even here, we shall reduce the loan, we shall reduce the liability account, and we shall increase the partner's capital account with the agreed value taken over. If the amount of the liability paid differs from the book value, then we shall debit the realization account and we shall credit the liability account. And of course, if in case there is a discount, then we shall debit the liability account and we shall credit the realization account. So in case, let's say our suppliers were demanding us 10 million when we were still doing business, but now because we are closing, they say, hey, instead of paying us 10 million, you pay us 9 million. So ideally, what was looking like, ideally we had our debit, our liability, sorry, we had our payable, which was worth 10 million. Okay. But now it so happens that this 10 million we have been told that instead of paying the 10 million, you come on and only pay us 9 million. So what are we going to do? We are going to come and reduce that 9 million, that 10 million, that extra money. I mean that discount. We're going to get that discount by debiting our payable with the difference. So it will be that 1 million, and then we shall go on and credit our realization account. So that means that we have gotten some extra, because we know that a discount received is money, is sort of an income. So even here we are creating a realization account because we have gained some money. Then of course we will have dissolution expenses. Sometimes we may not only be the ones doing this whole dissolution, we may call in some legal people, authorities and whatnot. That is going to affect the realization account by debiting it, and then we shall credit our cash account because we are paying out. Then in the whatever account balance is going to remain, okay, we're not going to now carry it as a balance carried forward. In case it's a profit, we shall debit the realization account and credit the capital account of a partner using the profit sharing ratios. In case it's a loss, we shall debit the capital account and we shall credit the realization account with the loss and realization. So do we have any questions for the journal entries? Let me just finish this. Then in case we are transferring the current account balances to the capital accounts of the partners, that is, we have been looking at, let me get my pen here. We have been looking at fixed accounts and fluctuating accounts. We said with fixed accounts, it's only one capital account, and then it also has a current account. And then we said with fluctuating, we typically have one capital account. So what happens when you're closing off a business with the reason for us to now start carrying around a current account, a capital account? No, because very soon these people are not going to be doing drawings, they're not going to be having profits to share, they're not going to be having loans and all that kind of stuff because the business is closing. So there is no need for us to have a current account. So what is going to happen is that we are going to close off our current account. Everything in the current account is going to be carried out and taken to the capital account, so that we stay with one account that is going to monitor everything for the partners. So after we have moved everything into the capital account, we shall then close the capital account of the partners to the bank account. So here you can see that we have paid the partners last. We have carried everything else remaining that was in the current account, we removed it, put it in the capital account, and then made necessary adjustments. Instead of having a capital account, a balance carried forward, we shall have a bank balance. If you don't get it now, it's okay. You're going to get it when we look at our question. So this is our pro forma for the realization account that you've been hearing me talk about. As you can see, we don't have anything that looks like balance carried forward or balance brought down. We have our assets that are to be recorded as net book value. We have our dissolution expenses. the excess on creditors. We have a share of profit on realization. That's in case it's a profit. Then on the credit side, we have our sale from assets. We have assets taken by the partners. We have discount from creditors. Then we also have our share of loss on revaluation. That's in case it is a loss. So these are just notes that you will be reading through. Let me take you through them. The balances, we're saying that the balances on a on a partner's capital account should be discharged to close the partnership books. So instead of having a balance carried forward, we shall instead have that money either paid into the bank. And if the partner is, you see, like last time we had someone who had a negative balance of 800. So if we have a partner who the business is demanding, then my friend, if the business is closing, you have to pay back the business. You won't run away with the business's money just because the business is closing. Just like those who have positive capital balances, that is to say, who have normal capital balances, will be paid back all the money that they invested for as long as the business has it. So the second note, we are saying that the final balances on the partner's capital account should always equal the amount in the bank account which they are to be paid. This is basically balancing both the assets and the liabilities. However, if the final balance does not pay out the partner's capital amounts exactly, then you know that you have made a mistake somewhere. So this is how you check yourself. Why that should make sense is because one is an asset and one is a liability, and when you offset them against each other, they should give you zero. That means that they should balance. Balancing is basically adding a negative plus a positive to get a zero, whatever the amount of figure it may be. The third note, we are saying revaluation account is prepared when the partnership is still a going concern, while a realization account is prepared only when the partnership is dissolved. This is just the difference between the revaluation account and the realization account. So we have a rule in when we are closing. We have a rule. What happens when someone let's say us here, we are 10 people, we are in a business, we decide to close it off. But me, I have decided that the business is demanding me. Of course, I've not decided. Maybe I picked money from the business, maybe I made drawings, and maybe you have been charging me a 10% interest, and I haven't been able to pay back that 10%. So it so happens that by the time we close, the business is demanding me, and maybe I'm not capable of paying back that money. This rule that we are going to talk about, the Ghana versus More law, it says, if you close a business, when you close a business with one of the partners not being able to meet his obligations, then the other partners have to pay for him. So if, let's say it's me, the business is demanding me 10 million, and I'm not able to pay for that 10 million, all of you, my business partners, will have to come together and pay for me that 10 million. How do you know how much you will pay out of the 10 million? We have been using profit ratios. Here, in the case of Ghana versus Murray, we are not going to use our profit ratios, but we will rather use our value of capital we had, the last optimal value of capital we had. That is to say, if we had our opening balances and each one of us had maybe 10 million to make up our business of 100 million, but me, I'm not able to pay off my obligation of 10 million. How will each one of you know how much you're going to give me? You're going to get your capital, your total capital, and look at it against the total capital of the business and see how much of that can be used to pay for your friend. So ideally, basically, the rule says you should pay for your friend when you close a business and your friend is not able to pay for his due. Please, as partners, come together and pay for him instead of throwing him out. So this case is a rule that they will tell you, like we're going to look at with one of the exam questions. They'll give you a question and they will tell you to apply the rule in Ghana versus Morris. So those of you who are not good with business law, you're going to have to be good with it. Those of you who are good with it, it's also okay, but this is just a snippet of it, so it's okay. So that's basically what the law is saying. With the transfer of profits or loss from the realization account and the transfer of current account balances to the partner's capital account, a partner's capital account may have a debit, balance. And a partner with a debit balance will be expected to bring cash to meet his deficiency. In case that partner is insolvent, that is to say, that partner has legally declared that they cannot be able to pay, and indeed there has been deemed fit that he can't pay his dues on dissolution, then the court back then for this incident that happened, that was back in 1904, subject to any agreement to the contrary, such deficiency was to be shared by the other solvent. So any issue, any money that the other party was supposed to pay and he couldn't, their friends were supposed to be the ones to pay it. When I talk about friends, I don't mean the friends he left back home. I mean his partners. So not in the profit and share, you don't share, you don't pay for that that due, not in using your profit and sharing ratios, but rather you use the ratio of the last agreed capitals. When we talk about last agreed, we mean the credit balances on their capital accounts in the normal balance sheet drawn up at the end of the last accounting period. So those are the notes basically to do with dissolution. I'm going to take us through an exam type question. I shared the question last week, the same one that has a Bilinga Charlotte. Just check the next question, and that's what we're going to attempt. I'm giving us a 2 minutes break and then we can start on the question. Question 8 is telling us, please, I hope you can see my question 8. And I hope you've also been able to access your own questions. Wanda, Kalea and Mambu are partners trading as wafanyakazi traders, exporting cereals to South Sudan. Their profit or sharing ratio is 4:1:3, respectively. Due to the insecurity in South Sudan, the partners have decided to dissolve the partnership. The following is a statement of financial position as at 31st December 2017. The non-current assets, we have 79. The machinery, we have 65. The motor vehicles, we have 16,000. For the current assets, we have 41. For the trade receivables, we have 25,000. But we also have a provision for bad debts being 2,000. That gives us a total of assets being 224,000. For the capital accounts, they seem like they were keeping fixed accounts. Wanda has 98 as his balance. Kalule has 20 and Mwambu has 62. For the current accounts, Wanda has 15. Kalule has a negative of 24.5. Mwambu has 11,000. Then for the other current liabilities that they have trade payables worth 23.5 million. There is a loan from Wanda worth 15,000. And then there is also a bank. So if you see, when you see bank in the liability side, don't think it's lost. The fact that there's a bank balance in the trade payables means that it's an overdraft, giving a total of equity and liabilities being 224,000. Additional information: the assets were realized as follows: land and buildings at 90,000, plant and machinery 45, inventory 20,000. Wanda took over the motorcycle at 14 million as part settlement for his loan. Dissolution expenses were 3.5. Accounts receivable were factored at 23.5 million, while Wanda took over 10 million of accounts payable, and the balance was paid off less 10% discount. Kalule could only manage to meet half of his deficiency before he became insolvent. Required. Prepare for wafanyakazi traders as at 31st December 2017. A realization account, a bank account, partners capital account using columnar format, a loan account, and payables account. So then they told us apply the rule in the case of Ghana versus Murray. So you see what I'm talking about. Let's go straight to our answer sheets. They have told us first and foremost to prepare the realization count. So I'm going to go ahead and prepare my realization count. Now, this is our format. This is our format for the realization account. So we're going to try to refer to this where we can. Now, first and foremost, we were told in our notes that at the moment you find out that you're closing a business, you close the asset account and put them in there. You take them to the realization account. And they told us first things first is that we're going to debit the realization account and we're going to credit the asset account. So that means that everything that is the value of the asset account, the value in the assets that we're showing in the asset account or the net current asset account, we are going to, sorry, the non-current asset account, we are going to remove it from those accounts and take it straight to the realization account. So I'll start off with my first asset, my land and building. How much was it? It had a net book value of 79,000. You may ask me, why are we not depreciating? Where is the net book value? This question didn't tell me anything about depreciation and net book value. So what is in the book that has been provided to me is what I'm going to take. That being the 79,000 for the buildings. Then for plant and machinery, it was 65,000. Apologies. Plant and machinery, it was 65,000. Okay, what was the next asset? Motor vehicles were 16. They had a closing balance of 16. Okay, what other assets can we carry out? We had, then we moved straight to the current assets. They told us we are going to clean out every single asset except for cash and bank. So inventory, we had 41,000. We're going to come and show our inventory value of 41,000. The next part, they told us the trade receivables, we had 25,000 worth of trade receivables. But these trade receivables, we had been even providing for bad debts, but now that even the business is closing, there is no way we're going to get that money back. Even if we go and shake those people, they won't give us that money. So we're going to take it like, This is money that we have lost. So the net trade receivable is going to be the 25 minus the 2,000, which will give us, of course, a 23. So we're going to come and indicate that as these are our trade receivables. Let's see, do we have any other assets here? That is it. Okay. So what else do now, since we have gotten our assets, we can decide to now sell them off. We have removed them from the asset account. Now we can realize them, or we can see how much was given to us as cash for those assets. When we go down to our notes here, the assets were realized as follows. Land and building was realized at 90,000. So I'm going to go, of course, that they were paid off in the bank. My land was realized at 90,000. My machinery was realized at 45,000. I'm going to show it there. How much were my inventory was realized at 28,000. Okay, so I think this, did we sell and did we see any other assets? Inventories were that. Motor vehicles, did we realize it was this guy who took the motor vehicle? They told us that he took the motor vehicle. Wanda took the motor vehicle at 14 million as part settlement for the loan. So Wanda was demanding the business 14 million. But instead of the business giving Wanda that 14 million, they told him, you take this car for 14 million. So now we need to find out. That means that the car ideally was realized at 14 million. How much was the actual value of the motor vehicle? It was 16 million. That is okay. So the loan, it will be an account on its own as well. We're going to call this the loan account. The vehicle was realized through the loan account, Wanda's loan account. So the trade receivable, what happened to the trade receivable? Did we realize them in any way? Dissolution expenses. Accounts receivable were factored at 23.5. It means that we realized them at 23.5. While Wanda took over 10 million of the accounts payable and the balance was paid off, less 10% discount. So we're going to come, the Felder's account receivables were factored at 23.5, and we're going to show that straight, and that will be it. But now, in this same sentence, they're also telling us that, so we have taken care of this 23.5. They're telling us how much was accounts payable. Accounts payable was 23.5. Okay. So 10 million of accounts payable, and the balance was paid off 10%. So Wanda took over 10 million of accounts payable. Apologies for that. Let me know if you can see my Excel. Can you see my Excel? Okay, Esther, apologies. I'm just seeing this comment now. But let's look at the questions that we get the concept better. Okay, where was I? So they told us that Wanda took over 10 million of accounts payable and the balance was paid off less 10% discount. So like I was trying to explain to you, what that means is that, yes, we had a loan of 23.5 million. Once again, I apologize for that. So they're telling us that Wanda took over 10 million and then the rest were given a 10% discount. So if I may just come back to my notes here, it means that out of the 23.5, 10 million of that was paid. So that was leaving us with 12. It was leaving us with 13.5 million. But of that 13.5, we paid off less 10% discount. So it means that we paid off that money, but we're given a discount of 10%. So what is going to happen is that we're going to calculate that discount and we're going to come and show in our realization account that we indeed had a discount. So if I may just calculate it from here. We had our loan of 23.5 million, but Wanda decided that he will take off a 10, which left us with a net of 13.5 million. But we were given a 10% discount. So I'm going to find out how much that 10% discount was. If we're given a 10% discount, it means that we paid 90% of what was left. So 90% is equivalent to 0.9. We paid 12.15. So for me to find out how much was our discount received, I'm going to get the 10% of that, which will be the 13.5. I'm going to come and put my 1.35 in my realization account. Remember, as per the format, we also have to put our dissolution expenses. So I'm going to come and also add my dissolution expenses, which are worth 3,500. According to the format, do we have anything else in the question that you feel we might have left out? Let me just show you the format in a bit. This is the format. The assets at book value, the proceeds from sale of assets, I have taken care of that. Dissolution expenses, I've done that. Assets taken over by partners, we have done that. Discount from creditors, we have done that. Excess on creditors, I don't think we had any in the question. So let's just go back to the question just to be sure that there is nothing else going to affect the realization account. Kalule could manage, Wonder, we already took care of that. Dissolution, we already took care of that. Accounts receivable, already took care of that. So I want to believe that is all for the realization account. So let's go ahead and balance it off in air quotes. The word balancing is in air quotes. So we can go ahead and add up how much is the debit side. I want someone to tell me how much the debit side is and how much and I also want someone else to tell me how much the credit side is. How much is the debit side? How much is the debit side and how much is the credit side? Debit 227. Thank you, Catherine. Say it's 227. Let me just also confirm. Okay, yes, it is. Let me see what the other answer is. For the credit, 201. So that means that the balancing figure is 227. I'm just going to come and add it on the side. So when we balance off the 227 against the 201,900, how much do we get? 227 minus the 201,900. 227,000 minus 201,900. It gives us 2,500. So that 2,500 is going to be, am I subtracting it the right way? 25,600. Thank you so much. 26,000. 25,600. So they told us, so this is supposed to be, ideally, this is supposed to be our balance carried forward. So if this was a business, if this was a going forward deal, then we would have our 25,600 as our balance carried forward. But because we are now closing off, we need to know, and we're now closing off, we need to know whether we made a profit or loss. If it's on this side, then if it's on the credit side, then it's going to be a loss on dissolution. If it is on the debit side, it's going to be a profit. We know that our balancing figure is on the credit side, hence that means that we have made a loss. These people are going to share this loss in their appropriate profit ratios, profit sharing ratios. So we're going to show how much they're going to all share. They told us their sharing ratio is 4:1:3. I'm just coming here to confirm 4, well, that is Wanda, Kalule 1, and Mwambu 1. So when I multiply, I am hoping my calculator is correct. Let me know if I have a wrong answer. I spread over the 25,600 by I spread over the three shareholders according to their profit sharing ratio. If this 25,000 was a profit, then they would earn that money equally. But now, because it's a loss, they have lost a bit of their capital, like we shall see by this exact figure. This is how our reconciliation account is going to look like. Do you have any question in this on you have any question to do the realization account for now? Okay, let's move forward.
I think you didn't see my question
Sorry.
in the text, but I was asking, why is it 26,150 instead of the 26,500?
Why is it
The loss
26?
under the loss realization, yeah.
Okay. Let's just balance it off so that we are all sure we have the right answer. When I add up my other side, I have 227. So ideally, the bigger side should be that 227. Let me just add up this other side as well. Because what we will get as the balancing figure is going to be what they will have to share. So when I add up 90, sorry, let me just, I'm adding up my 90, 45, 28, 14, 23, and 1.3 should give me that. So for me to balance off, I have my 227. Apologies for that. I have my 227 minus 201. So it's 25,600. Let me just put it here because I need to, we are now going to share it. 25,600. So you are asking why is it 25,1? No, it's supposed to
Why
be
are
20.
we using
Uh,
the 26,150 instead of the 25,600?
it's 25,600, not 26,150. But we can still go ahead and reapportion because now we know that we have 25,600. I'm just going to remove this.
Okay, according to the working, okay, yeah, okay. Because according to the working, it is 4/8 times 26,150.
Oh,
which I would
that.
think it would be times 25,600.
Okay, that is an error in the editing. Let me manually calculate. That is 1/8 times this 25 that we have gotten. And the next is 3/8. 3/8 times 25,600. I think that is it. It was an error. It's an error here. Thank you for highlighting that. Let me correct it. 25,600. Okay, we can move on. Thank you for highlighting that. So I believe we are okay with the realization account. Let's see what the next part of the question was asking us to find. They asked us to find the bank account. Okay. We're going to, of course, create our T account and find our bank account very, very smoothly. Of course, as usual, don't forget our headings. We are good students by now. We know that we have to show our headings, our currency, and the level of precision. So first and foremost, free mark, we saw in our question that the bank account was 4,000 and it was an overdraft, which is here. I'm going to come and show my balance brought forward for the bank. My balance brought forward for the bank will be the 4,000. Now, since we already have at least one account to cross-reference with, we can just come and pick all the entries that we made here in the realization and take them to the bank account, inclusive of this dissolution expense. So I'm just doing double entry. So I'm going, all these are bank transactions. We sold land, the money came to the bank. We sold off our plant and machinery, money came to the bank. Inventory, same story. For the loan, no. For the receivables, same story. And as well as the dissolution expenses. So I'm just going to do a double entry for that because I already have those transactions. There's no need for me to repeat. So my dissolution expenses reduced, of course, they reduced my bank balance. Then all the other realizations that I might have made are that. Okay, what else did we paid also for loan payable. Remember when we calculated the 12.1 against the discount, that was it. All the other, we're going to just do the rest of the question. We have at least filled in the part of the bank. We need to also find what else is going to affect the bank. But for us to find that out, let's just go back to the question a bit. I have just picked the double entry for what we had already done. So now we are going to go back to the question and see what else is supposed to fill. Supposed to go to the bank account. Okay, for the statement of financial position up here, I believe there is nothing else going to the bank. We have already taken care of all these assets. Maybe in terms of capital and people who are supposed to pay us, or people who are supposed to pay back. So we have already looked at the realization monies. We have looked at the motor vehicle. It was not affecting the bank account at all. The dissolution have affected the bank account, and we have seen that. Accounts receivable were factored at 23.5. Did we have we shown them in the bank? Let me just, yes. Oh, sorry, let me just check the bank account here. Yes, we have shown the accounts receivable. What else affects the bank? We have shown the accounts payable as well. Kasule could only manage to meet half of his deficiency before he became insolvent. So Kasule could only pay half of his money. We need to now first adjust Kasule and see what else is there that may affect the bank. So for now, I'm going to put a pin, going to put a pin in the bank and see where else, what other monies could have affected my bank account. Okay. I could start off with the loan from Wanda, see if it affected the bank account. Wanda gave us a loan. He had his current account at 15. The notes told us Wanda took over a motor vehicle at 14 as part of his loan. Sorry, so we have his loan here, loan from Wanda, which is 15,000. And they're telling us that he took over the motor vehicle at 14 million. So we're going to see where the other 1 million went. Probably it affected the bank account. So I'm going to create my T account, loan from Wanda. If it's a loan, then of course it's on the liability side. It has a normal credit balance, which was that. But remember, Wanda settled. Sorry, we settled off Wanda by giving him a car. So we gave him a car worth 14 million. We realized 14 million by paying off Wanda's account. So we're going to come and show that 14 million that we realized. So ideally, that means that Wanda was demanding us for 15 million, but we're only able to pay off 14 million we paid off that 14 million by giving him a car. So that extra 1 million, it means ideally we paid it to Wanda, because we have not been told anywhere else where that extra 1 million went. So balancing off our account, we show that the other money was given to Wanda as a form of payment back for the loan. So I'm going to carry my double entry. If we paid off Wanda, that means that in my bank was credited with the 1 million. So I'm going to come and show that I have a loan payment to Wanda. Okay, so we've adjusted that. We need to find out what else. Let's go back to the question. What else could have affected our bank account? Dissolution expenses, we have already taken care of that. Accounts receivable were factored at 23.5 million, while Wanda took over his 10 million or accounts payable, and the balance was paid off less than 10% discount. Is that going to affect our bank? Let's try to create a trade payable account and see if it's going to affect our bank balance. So we start off, of course, we have our balance for trade payables being 23.5 million. We're going to come and show our opening balance being 23.5 million. What else affected our opening balance, our trade payables? As far as I can remember, we had a discount here that reduced those payables by 1.35. Then before we even reduced the payables, they told us that Wanda took over 10,000 of that loan. So I'm going to show that Wanda's capital increased by 10,000, but as he reduced our payables by 10,000. And then after Wanda had reduced our payables by 10,000, we were able to get a discount on the remaining money. So that means that ideally, all the other money that wasn't taken up by Wanda or wasn't a discount received was paid to the bank. So I'm going to come back to my bank. I think I'd already taken care of my trade payables. Okay. So next part of the question, Kalule could only manage to meet half his deficiency before he became insolvent. So now we need to find what Kalule's deficiency was before we even find out what half of that was. So by the moment I hear the name Kalule, I know that is going to affect my capital accounts. So I'm going to open up capital accounts for my shareholders and see how these movements are going to happen. Sorry, for my partners, not shareholders. Excuse my English. So I'm going to open up my capital accounts like you see there. I hope you can see my screen very well. So ideally, because they are capital accounts, they will always have a normal credit balance. So the balance brought forward for the capital accounts for Wanda, Kalule, and who? And the friend. Wanda was 98,000, Kalule was 20, and Mwambu was 62. I'm going to come and show those opening balances. Opening balances for the current account as well, they are always on the credit side. So what are the opening balances for the current account? Remember, we said we are now going to keep everything in one account, in one capital account. So Wanda has a current account balance of 15,000. I'm going to show it there. Kalule has a debit balance. Kalule has a debit balance, so it's of course going to be on the debit side. I'm going to come and open Kalule's balance brought forward on the debit side. It means that Kalule ate business money, or the business is demanding Kalule. That's why he has a debit balance. The other partner, how much did he have? Mambu had 11,000 in his current account. I'm going to show that 11,000. So we could just start off. We know that Wanda had already taken care of the trade payables by saying that he will take care of the 10,000 of those trade payables. Then we could also come and do double entry. We have here loss on realization. We could come and carry out the corresponding entry for the different partners. The fact that it's a loss, it means that their capital is going to reduce. Capital reduces on the debit side, or capital reduces by debiting it. So we shall come and show their losses there. So we could try to balance off. Do you think we could try to balance off? For people like Kalule, I know there is no other thing that Kalule did. So I'm going to find out. I could try to only balance off Kalule's account, because at the end of the day, the question is telling us we are trying to ascertain how much Kalule was owing, or how much he even paid in half. So before we balance off any other person's account, let's first meet off Kalule's insolvency. He could only manage to meet half of his deficiency before he became insolvent. So before we close off the business, let's see how much Kalule was being demanded. So when I balance off Kalule, his current account plus his loss, he has a debit balance of 27,000, but he had his capital already. So when I subtract 20 minus that, it gives me 7.7 thousand, or 7.7 million. They're telling us that Kalule paid half. He could only settle half of what he was being owed. So that means that Kalule was only able to get half of 7.7. So what I'm trying to do, I want to get half, that is 0.5 of the balancing figure. Or let me balance it off first. The balancing figure in Kalule's account is 7,700. I don't think I am giving the right answer. Anyway, it's okay. It should be this 27, because I'm trying to balance off. So Kalule is supposed to pay back the business 7.7 thousand, but they have told us that he can only afford to pay half of that money. Okay, so I am going to show how much he can only afford to pay. Half of 7.7, if I may just divide it from here. How much is half of 7.7? Divide by 2 is equal to 3,850. That means that Kalule could only afford to take to the bank 3,850. Meaning that the other half, the other 3,850, he couldn't afford. But before we find out what happened to him, because they told us to use Ghana and Murray, let me carry my entry. I have now gotten an extra bank entry. Let me carry it and show it in my bank account. So you see, I'm dealing with multiple accounts at this all at the same time. Kalule could only afford to give us back half of what he was being demanded. So we need to find out how the other half is going to be taken care of before we can close the business, okay? So the law of Ghana versus Murray tells us, why I'm talking about the law is because they told us to consider that law. In the question, they told us, consider the case of Ghana versus Murray. So they told us that when we are considering this, the partners, the active partners, other partners that are able to, will not use their profit and sharing ratios, but instead they will use the capital. Let me just go back to the notes just for a second. The law says a partner, in case the partner is insolvent and thus unable to meet his dues on dissolution, court ruled, subject to any argument to the contrary, such deficiency was to be shared by the other solvents, partners, not in their profit and sharing ratios, but in the ratio of their last agreed capital. Here, meaning the last agreed capital being the credit balance Can you hear me? Please let me know if you can hear me. Okay, thank you, peace. So like I was telling you, it instead of the case of Ghana versus Murray encourages us that instead of using the profit sharing ratios, we shall use the credit, we shall use the proportion of the capital that was there in the last, or in the last accounts that basically we produced, or in the last balances that we had. So we're going to go back to our statement of financial position and look for the capital accounts. So for Wanda and Kalule and Mwambu, they had 98, 20, and 62,000 respectively. But we are trying to see how much they can contribute for Kalule. Kalule was only able to afford 3,850, and he couldn't pay the other 3,850. So what these other two will do, they have to look amongst themselves and calculate and see how much each of them can contribute for Kalule. So we are going to come and create a schedule here. Share, we're going to call it share of Kalule's deficiency. How much then? Then we can start with Wanda. Wanda had capital of 98 million. So it will be capital of 98 million out of the total capital that is available. So we are trying to get the percentage of how much Wanda actually owns. If that business now owns total capital worth, because now since Kalule is he's insolvent and he can't pay anything, his capital barely even has any value right now. So the total business right now is only worth 98 for Wanda and 62 for Mwambu. We need to find the percentage of how much is Wanda's share out of this capital and how much is Mwambu's share out of this total capital of 160. So that is why we are getting our 98 of Wanda's share out of the total capital times. So before we go to the times, so for example, if we want to know how much Wanda's capital contribution is in terms of percentage, I'm going to get his 98 million, divide it by 98 plus 60. We say that's 160. Is 98 million. That means when I change that to percentage, means that Wanda shares 61% of the capital. What means that Wanda owns 61% of the business. So if he's to pay back Kalule's money, if he's to pay back that, if he's to help Kalule pay, Kalule, the business is demanding him 3,850. So Wanda can only pay back 61% of that debt. 61% of the debt, which is 23,500 and 22,358,000. So that is how much Wanda can pay according to the level of capital he has. He has 61% of the business. I've just tried to break this formula down for you and show you what it means. Okay, so Wanda's share of deficiency will be the total of Wanda's capital out of the total capital times Kalule, so that we know how much he can actually pay for Kalule. When we multiply that, we will be able to get 2,350. Mwambu's share, it will be the same thing. We shall get 62,000 of Mwambu's total capital is 62,000 out of the total capital, which is 98 plus 62,000 times Kalule's money that he has failed to pay. When we multiply that, it shows us that Mwambu can only pay 1,491,000 of Kalule's money. So ideally, when you add up this 350 plus the 149, that is minus rounding off, of course, I'll get 3,841. How much was it? I didn't round off, so that should be okay. He demands us 3,850. For lack of benefit of doubt, let me add up all the figures. 125, 875. Still inaccurate. So that means that there's an issue with my calculation. We're going to have to recalculate. We said 62,000 divided by, I already know that 98 plus 62 is 160,000. 160,000. That is equal to 0.38. I'm just going to change that to a percentage, which is equivalent to 39. So 39% of 3,850 gives me 1,419, which is equivalent to this. When I also use the same, when I also get the same example, 98,000 divided by 160,000, that should give me 61% when I make that a percentage. When I get 61%, sorry, I already have it here, excuse me. 61% times, excuse me, my computer is a bit strange and funny today. When I get 61% of the money that Kale can't pay, I get 25. So the error is with this. It's supposed to be 8. So 23,500 and 2,358,000. So that is how much Kalule is supposed to, Wanda is supposed to pay for Kalule. We are going to come and show that because they tell us that these partners, before anything, they have to take care of the person who is insolvent. So we're going to come and also allocate that insolvency, Kalule's insolvency, onto the partners. So that means that their money that they would have received is going to reduce by the money that they're going to pay for Kalule back to the business. Wanda's money is going to reduce by 2.3, or Wanda's capital is going to reduce by 2.3, and Mwambu's capital will reduce by 1.4. So then we can find out, we can decide to balance it off. So the double entry for that, because we need to also be able to close off Kalule's account. Remember, he can only pay off half for himself. We need to show where the other half has come from. By completing the double entry, we show that Wanda and Mwambu are the one who paid for him. So ideally, when we add up this 20 plus the 38 plus this, should be able to give us 27,000. So Kalule is clearly now balanced. We can now balance off his colleagues. This side, Wanda has 123 and Mwambu has 73,000 on the credit side. When we balance that off, I can just get the difference to the balancing figure for Wanda will be that The balancing figure from Mwambu will be that. So instead of calling this the balance carried forward, this because the partnership is being dissolved, this money will actually be paid to them. So Wanda will bank, or he will go home with the 107,000, and Mwambu will go home with the 61,900. This will be paid into their different bank accounts. And so we shall make the corresponding double entry for that by showing that we paid out Wanda and Mwambu's capital money. And so we can go ahead and balance off our accounts. When we add up this, 90 plus 45 plus 28 plus 23 plus that, it gives us 194. When we add up the 4,000, that was the overdraft, plus the 35, plus the 1, plus the 12.1, plus the 100, plus the 61, it gives us 190.4. There is no need for us to have a balance brought forward or balance carried forward. The bank account itself is supposed to balance itself out. That way you will know that you have balanced off your account. I apologize for my frequent network disturbances. I'm going to have to change a service provider. I'm having a bit of issues. I truly apologize for that. Otherwise, do we have any questions?
Is it okay we go through another example next time on the same topic?
It's okay. I can organize for that. I can organize. Do we have any other question? Okay, thank you. Let's meet on Monday. I hope you've been notified. You'll be having only a Monday lecture from now on. We have just company accounts left, so we'll be having only one lecture a week. So we meet again next week on Monday. And for those of us who have not, if you've missed out any lectures, please check your student accounts and let us know if you can see your lectures or you cannot. But everything has been uploaded onto your accounts. Otherwise, thank you and have a good night.